Welcome, everyone. We're excited to get started on today's webinar. I'm Brenna Nath, HW Plus Managing Editor here at HousingWire. Our topic today is on how leaders in lending are driving results through new technology sponsored by Capacity. A few quick housekeeping items that I want to go through. First, we will be having questions and answers throughout the webinar, so feel free as we're talking and chatting and discussing this information to submit your questions, and we'll get to it at the end of the different sections. So feel free to ask away throughout, but we'll also have a dedicated Q&A section at the end. So if you do want to, if you come up with the questions at the end, feel free to submit them then as well. Also, HousingWire will be sending a recording of the webinar within 24 hours to all registrants, so be sure to check your email there as well. And so jumping right in, we are joined by three experts today. First, we have Justin Smith, who is the Vice President of Marketing at Capacity. Second, we also have Scott Roller, who is the founder of VendorSurf. And then lastly, we're joined by Kartik Kumar, who is the Global Mortgage Practice Head of Tata Consultancy Services. He's responsible for leading the TCS mortgage practice with industry disruptive digital cognitive solutions and products for the global mortgage industry. He's focused the last 2 decades in mortgage transformation, solution architecture, operational delivery, project management, compliance management, as a change agent for technology endeavors. He is an international speaker, host, and facilitator known for disruptive change and digital transformation at various forums. So excited about those intros. Let's go ahead and jump into our first question, which I'm going to direct to you, Kartik. What has worked well in the U.S. mortgage industry?
All right. Thank you so much, Brenna, for those introductions. I would say there are a couple of things that have worked really well. And let me start with the digital point of sale solutions. Over the last couple of years, consumer-facing technology has worked really well. Let's give it in. We went there with the rest of the industries when they started, but we've really caught up, and that's working well. Today, things like automated verification of asset, employment, income, these things are working really well. The industry has evolved pretty much there. Another point that really worked well for us compared to other industries is resilience from this COVID crisis. It's a never seen before kind of problem. The kind of immediate support the GSEs gave, the kind of flexibility we got on appraisals, closings, and what you could term as digital proximity and social distancing, I think that worked well. And it worked well because of great support from an ecosystem of players. One more point that I can think of is excellent technology and network support to make work from home or remote working easy. This isn't an industry that's known to adapt technology overnight. Let's accept one fact. And given this entire quarantine and all this COVID situation coming in, the speed in which all the employees moved remote, we've had underwriters in our industry that moved in remote couple of years ago, but the speed in which this has moved is really commendable. One more interesting part about the overall industry is that I would call this as a free market space. It's an open choice to borrower. There's an equitable competitive space. We have large and significant players, but I wouldn't say it's a monopolistic situation. So borrowers have all the choice in the market. And this is enabled by great technology that has worked. So that's kind of what I feel about what has worked well in US industry.
Okay. I also want to open that up to you, Scott and Justin, as well. If Scott, you want to chime in there.
Thank you, Brenna. Thank you, HousingWire and Team Capacity. It is an honor to be here today. Welcome to my home from beautiful St. Louis, Missouri. When I think about what has worked well in the mortgage industry from a fintech perspective, I really think about 4 key dynamics or trends. The first is there's been a major shift in lenders sort of retrenching and sticking to their core competencies. And that typically always isn't the case. I can think of within the past 20 years, they were very CIO driven, and IT could build everything, and we'd never buy anything off the shelf. There's been a massive shift, I'd say, in the past 15 years. Lenders stick to their core competencies. They try and find borrowers to meet those financial needs. And then, they underwrite loans, and in some cases, they still service. Other than that, it's often best suited for vendors to develop and deploy the latest technology. It's especially true in a rapid innovation cycle like what I believe we're currently in. And these vendors can leverage best practices and lesson learned from other deployments, even if it comes from other industries like healthcare, for example. So when you engage a vendor, I think these lenders are smart because it raises the collective IQ of the deployment and the planning. Second, we are embracing fintech vendors, I think, quicker than ever in the past. Venture capital backed vendors are starting to understand that they need to come to the table with in-house mortgage expertise. Just because you get a lot of money and something super cool, there's been a bad taste in the industry's mouth for a lot of years, and I think that's starting to change. These VC-backed firms are now quicker to understand that they need this in-house expertise, and that mortgage is not credit cards and it is not auto lending. It's very different. We have a massive and confusing legal, regulatory, and compliance gauntlet to navigate, and it's never static. It doesn't just sit there. It's always changing. So I can tell you from experience, having spent nearly a decade running vendor management at a top 5 mortgage bank, it's nearly impossible to get internal IT support. You get the hand in the face and it says, is this legal, regulatory, compliance related? And you say, not really. Then it's 18 to 24 months. Come see me then. So it's really, it's not like other industries. Historically, we've been a very tough market to crack and penetrate. Short, unwelcome mats and long on, call me next year. This has hurt the industry in the past. Tech innovators get a little frustrated and they go elsewhere. But I think that's the tide has changed. We're easier to get to today. We're seeing a good influx. And I think the net message is you can't keep great solutions out. And that results in ROI will always prevail. The third trend I see is instead of or in lieu of M&A, which is always big in this industry, and it continues to be today. If you saw a couple of announcements just in recent days, gigantic. But there's alternatives that are cropping up more than ever, and that's strategic collaboration between vendors. You've got CRM and point of sale systems collaborating, doc prep and e-sign. You've got compliance and due diligence firms teaming up with vendor oversight platforms. And when you think about it, these people aren't worried about what's this merger and acquisition mean for me and my job and my staff. They're a lot less concerned. There's probably more focus on the market and the client, which is always good. Then the last thing I see on what has worked well is just big data meets new technology. There's massive amounts of new and expanded data sets more than ever before. And this new technology is helping mine it. You've got AI, machine learning, robotic process automation. Many of these things have been proven in other industries, so they're tried and true, and they're being overlaid across our ecosystem. There's even some derivatives, conversational AI and augmented AI, which is, hey, we'll never totally get rid of the human. It keeps the human in the loop. One of the things I'm a huge fan of, predictive analytics. You'll see that throughout my discussion today, and we'll discuss. So later on this call, we'll actually talk about some of these technologies and explain some specific use cases, go down into the weeds a little bit to get the creative thinking juices going on how this might apply to you and your business. So the message here is data scientists have arrived, behavioral scientists have arrived, and it's leading to a stunning transformation as we combine these two. So unprecedented gains in speed, quality, customer sat, at a reduced cost over the long term. So that's what I see working. Brenna, back to you.
Yeah, and I'll pitch it to Justin real fast. Would love to get your closing thoughts on that question.
Yeah, absolutely. And again, thanks to the Housing Wire team for hosting us, and thank you, Scott and Karthik, for joining me today and presenting here. So from our perspective as a vendor that sells into the mortgage space, we are not, with our customers, we are often not the only technology solution they've invested in to sort of further the business. So while on one hand, as the marketing guy at a vendor, I've got a sort of specific view into how our customers are seeing with our product, I can also tell you just in general, looking at who's winning and what they're doing. And there's really, the way I look at it is in two ways. So on the origination side and creating more loans in the first place, we're seeing lenders have success who are adopting digital first and meeting their customers where they are, right? So whether that's a well put together website with the right information in the right places, or that's a quick and easy point of sale system to get the loan sold as fast as possible, or if that's a back end sort of augmenting their loan officers to help them close more loans and close them more quickly. And that's where capacity comes in. That's where we're seeing most of the success there, is just people who are leaning into taking advantage of the technology that's out there to close more loans, do it more quickly. I mean, at the end of the day, that's the name of this game, right? On the servicing side, I think what's interesting is there's a real good opportunity to automate a lot of the processes there, right? So servicing is a very data and rule driven flow. And this is where automation tends to sort of work its best, right? And I think this is going to be especially important in the coming months as forbearance requests and, God forbid, defaults and stuff start ramping up. But even aside from that, refinancing and all the other things that are going to happen here with the market conditions being that they are, being in a position to have your processes and your business designed in such a way that you can intake some of these tools, quickly deploy them and see the results, those are the people that are winning.
I like the way Scott put it when he said our industry doesn't have a lot of welcome mats.
Yeah, I wrote that down. I'm definitely stealing that one from you, Scott.
It's a good t-shirt quote.
I'll see you next year. Yeah.
I did want to remind everyone who didn't hear me at the beginning, we are taking questions throughout this webinar, so feel free to submit them in the Q&A function below, but we'll also have some questions at the end. So feel free to submit them whenever, and we will get to them as we can. This next question, I think, serves right into a lot of us can learn from what doesn't go well. Once again, kind of starting off with you, Karthik, at switching that question from the first time, which is what has not worked well in the U.S. mortgage industry?
All right. And you said this webinar is just for 1 hour, because I could go for a couple of hours on the things that haven't worked. Let's just start with one fundamental problem that the mortgage industry has. It's the papers. We're talking about an extremely document-centric industry, an average of 300, 350 pages per loan. The extent of automation, adoption of technology is all crippled and paralyzed because of the kind of documents. You have very limited structured documents, you have diverse unstructured and semi-structured documents. It just makes adoption of technology extremely difficult, because there's too much of dependency on very good OCR. On another point, the front office, like when we spoke about the good things, the front office really has been working well, but the back office operation is still taking time. If you look at it, just pull up any report over the last couple of decades, the productivity per employee or cycle time hasn't changed much. It's in fact, ironically, if you pick the Stratmore monthly closing reports, in the last 7-8 years, if you look at it, the loans closed per month or the number of underwrites per month have come down, and I'm not talking about the anomalies or the really efficient ones like the Loan Depot or Quicken, who are, closing things in 7-8 days. But I'm talking about an industry average. Why? Why is it that, things haven't changed? Looking at it, that lenders on an average have been spending $100 to $150 million in technology annually. That's the kind of spend. But the average cost of origination hasn't come down with these significant level of investments that have been done in technology. So where exactly is it? Is the industry focusing a lot on consumer facing, or the industry isn't looking at efficiently managing their back office, or are we not seeing the kind of results? look at it, there could be fundamentally a lot of issues. It could be paper, it could be legacy systems, it could be what is called as your monolithic systems that don't adapt to change, and that they don't show flexibility. This is all about within the organization. Let's talk about one interesting point outside of an organization, that the mortgage industry is, when it comes to innovation, it's focused more on process innovation rather than on product innovation. And let me just give you an example. In terms of product innovation, always the key drivers behind the growth of this industry is housing price change or an interest rate drop. That just churns a lot of action and activity. Unlike other economies, we do not have too many innovative products in the market that tempt home ownership. Are we telling a millennial that, first 2-3 years, go on a lease to buy kind of a thing? We'll work on some unique products. It has to be encouraging enough. See, as an industry, the mortgage industry is extremely critical for the success of the housing industry. How innovative our products are, how acceptable our products are, and what kind of products we present is important. So I would say a lot more of focus on process innovation rather than on product innovation is happening. On moving focus into the servicing side of business, let's just take JD Power survey. It's a known survey. I don't need to say more. That says the 2019 survey says that 70% of customers don't have trust in their servicers. It's supposed to be a very simple transaction. If I was to look at it as a borrower, I just have to give my monthly P&Is and my escrow gets handled over the life of the next 20-30 years. Why is it an amount of dissatisfaction? Look at mortgage industry as a whole when it comes to the net promoter score. They have a scale of -100 to +100. And most of the industries fall in the average of 30 to 50. And the median net promoter score is at +44. And mortgages is at 16. Does it, it's not as inspiring, be it fulfillment, be it servicing. When, people talk about getting other type of loans, it's all on a click of buttons and in less than 24 hours. Why is it that we still on those 40, 45 days, 60-day buckets? So there's a lot of encouraging things that are being done, but that's what I had as a prima facie comment on what's not working in the mortgage industry.
Wow, 70% is quite a stat. I'll let Scott kind of expand on those thoughts.
Nice job, Karthik. Good stats, good detail, and rather shocking on many regards. So what has not worked well? The thing that I see most is sort of shooting ourselves in the foot. We have found the enemy, and it's us. When desperation beats out strategy, what I mean by that is there are too many lenders that are mostly motivated when things turn bad. Arguably, the latest strides forward, the big leaps forward in tech and impact have been driven by two crises, the Great Recession of 2008 and the current pandemic. It's when everybody gets motivated. So when we wait for desperate needs instead of strategic action proactively, it becomes problematic. I get it. It's hard to step away from the low rate feeding frenzy. Vendors right now, though, are being told by and large, now is not a good time to talk to me from a lender perspective. But here's the problem with that. When is a good time?
Right.
You guessed it. A good time is when the feeding frenzy is over and it starts to flip to a purchase market and people feel like they can breathe again. But here's the biggest problem with that. It's a never-ending vicious cycle. Everyone gets motivated at the same time. Vendors get overwhelmed. Demand far outstrips supply. Vendors simply cannot get to you. What's the result in that? If you're a vendor out there and you've got a lot of opportunities, which ones are you going to pursue first? The largest revenue opportunities. So the question to a lot of you lenders out there, where does that leave you today? Perfect example, remote online notarization. Not a recent past issue, one we're currently living. Demand has far outstripped supply. There was a rather slow adoption until the pandemic, and then a whole industry all at once overnight, can't live without it, got to have it now. RON vendor deployment pipelines are bursting at the seams, overflowing, and most potential clients are waitlisted. It's a heavy lift for everyone, especially lenders, and it's become clear to me that there's a fair amount of lenders out there that really don't know what it means to deploy something like remote online notarization. It doesn't sound that much at the descriptive level, but it literally takes months of aggressive planning and a team of people, and you don't just deploy. So lenders are encouraged to find a way to commit to a tech strategy, regardless of the volume cycle, and be guided by a tech roadmap. This vicious cycle will continue to repeat itself. And again, I ask the question, where will that leave you the next time? A second issue, I think, is that in my belief, when people talk about fintech and deployment, it boils down to two areas: sales and e-closing. Digital applications, digital 1003s and e-closing, they've become compulsory. If you're not doing one or both of those, you're on a perilous path. They are table stakes. They're very consumer focused. That's always a great place to start, but it's not enough. You've got your internal enterprise opportunities that are largely going underserved. There's missed opportunities for productivity, workflow, things that lead to improved customer satisfaction, repeat business, and stemming employee turnover. So processing, underwriting, post-close, compliance, servicing. Karthik talked a lot about servicing. Servicing they're not 20 years behind in general, is what I hear from people I talk to. There may be 35 years is the general consensus. And there's so much opportunity. So I think in my mind, that missed opportunity across the enterprise is the biggest tragedy. Fortunately, it's not hard to find vendors that have enterprise-wide solutions that are not one-trick ponies. So let me share that at the bank, I ran vendor management for almost a decade, and I was known as the party of no, the killer of sales. And the reason why is when you run vendor management at a big lender, you can't please very many people at all. It's impossible. These days, if I were still in that role, I think I'd be getting some relief. The bigger villain wasn't me, it's employee turnover. There are years of intel on why loan officers leave. And one of the biggest reasons is a lack of technology and tools, especially the top performers. They will leave at the drop of a hat and take their millions of their book with them. And who stays behind? The not so top performers. LOs need more selling time, not administration burdens. And the best LOs know that fintech enables compensation. So tech is really becoming the great equalizer in the brutal battle for top talent. Reminds me of something I've seen multiple times in my life, this little banter between a CFO and a CEO. The CFO says to the CEO, "What happens if we invest in all of our people and develop them and they leave us?" And the CEO says, "What happens if we don't and they stay?" That's insert development, insert technology in the word of development, and you end up with the same proposition. The third thing that I think is really plaguing the industry is heavy lift implementations. This isn't necessarily my own view. I do share it, but I have heard this so much lately from all the discussions I've had. Very few lenders have an army of people to implement what you've got. These 9 to 12 month timelines are becoming extinct, and they are deal breakers. So key drivers have become cloud-based solutions, software as a service, agile development, API and gap implementations. And if you talk about the product that you're out there building, the solutions themselves are changing. Those that are more modular and component-based, where you can plug and play, a la carte versus one size fits all. I've heard so much lately that there's a lot of cool stuff out there, especially in the POS and the CRM world, but I only need a couple of those things. It's feature rich, but I need this much, but I got to pay this much. So I think we're headed toward a, the question begs, are we headed toward a buy and try environment where deployment cycle times will become easier, quicker, more hassle-free, and people will jump in, sign a contract, short-term contracts, and then cast it aside and move on to something else. So I think it's a distinct possibility in which time will tell. The last thing I'll say about what's not been working well, implementation isn't just a responsibility of the vendor side trying to implement their product at you lenders. Other points of failure that I see a lot are procurement teams are not represented by operations and implementation teams. There's a disconnect. Somebody else brings it in without a whole lot of consultation on the user community. And that's tough. Not doing a soft launch first, trying to do a total cutover all at once, the entire population is been unwise for some deployments I've seen recently. And you've got an entire tech stack. You've got LOS, POS, CRM, many doc systems, and failing to consult these other vendors in what their role and timeline and support and what their needs are going to be. So it's likely, while I'm utterly shocked to constantly hear, gosh, our employee adoption rate of this is terrible. It blows my mind. Nobody's using what we just deployed. So those are the things that I think have not worked well in our industry. So Brenna, back to you.
Yeah, you made a lot of really great points in there, great notes, but I do value that the word cool snuck in. You don't hear the word cool in a mortgage webinar too often. Passing off to you, Justin, to kind of expand on some of that.
Yeah, that's a tough act to follow there. Scott just all took us to church. So so for me, the two things that have come to mind, in preparing for this discussion, hearing Scott and Karthik, and then also obviously just in my day-to-day, it is very clear that you do run into lenders sometimes who just want to grab whatever the latest, hottest thing off the shelf is, toss it into their organization and hope it works. And there is a commensurate amount of upfront understanding of your business and your business processes, your technologies, what data is available via what APIs in those technologies. So when you actually install the stuff, to Scott's point, you're not having people complain about low adoption rate on the technology and the tools that you just bought. So that's one. And the second one, and this is also something that I think is not just unique to the mortgage business, but Karthik touched on this, and I couldn't agree more. So that same JD Power survey, they also had a really great data point in here. It's a great survey. Everyone, or report, everyone should go read it. But this is the number one thing I thought that was so fascinating. More than 3/5, 62% of customers visit their lender's website as a first line of information, but only 28% say online is the most effective channel by which to resolve an issue. Among those who couldn't resolve their issue on the lender's website, 45% say the issue was resolved only after picking up the phone to speak with a rep. So what that tells me is, in a post-COVID environment where every trend that did exist is just getting accelerated, you have this, which I think is a super simple, easy thing for lenders to sort of address, and it's all staring us right in the face, and that is digital first communication with your customers, with your borrowers, is more important than ever. And I sometimes, I don't know how else to say this, other than kind of bluntly, sometimes I think the mortgage industry embraces the sort of necessary evil of everyone's got a mortgage, everyone's got to pay their mortgage. If I pay it on time, why should I ever talk to my servicer for 30 years, like Karthik said? And the truth of the matter is that people have questions, people have concerns, people need to know what their options are if the unexpected happens. And 2020 has just been a giant lesson for all of us, and that the unexpected will happen. So for me, when I see, and this is kind of across the financial services, whether it's banking, mortgage, even your Ameritrade account, whatever it is, people need answers, people need information. There's technology that makes that information more easily available. And in the AI business, we like to talk about graceful handoffs, right? If the AI cannot deal with whatever the situation is, you pass off to a human. So human in the loop is the other way to put this. If you are going to deploy technology to help people, help your customers get satisfied and get their answer quicker, you can't just stop there. You also need to work on what you can do to augment the people answering the phone for when that graceful handoff does happen. And if you can, to Karthik's point, if you can provide better service, that net promoter score is going to go up, and net promoter score goes up, churn goes down. You can keep your investments, or I'm sorry, you keep your customers happier longer. You can make more investments and sort of expanding revenue with the customer base that you have, more marketing, more sales, all that other stuff. So I think that at the end of the day, this kind of reluctance to embrace the reality of our times is something that, as a vendor of this technology, I see a great opportunity in the mortgage space, but as we all are also consumers of the mortgage business, is something that I think is stands out when you look at what doesn't work.
That was a great wrap too to both of those points. A lot of great notes coming from this. I did get one question that came from the audience that leads perfectly into your to my next question for you, Karthik. So kind of let's start with the audience question, which is what's holding up product innovation? And from there, kind of leading into my question for you, which is what mortgage innovations have you seen outside of the US for comparison? So let's first take a look at what's holding it, and then let's look at other places.
Sure. If you're talking about product innovation, if you have to innovate, you have to plan. You have to look at what is your end objective. Our industry historically can look at proactive planning or reactive planning. Just think of the last time US mortgages didn't do reactive planning. You walk into any services office, they are overwhelmed with the volumes of forbearance requests and the upcoming servicing related work that's going to come. And on the fulfillment, there is not a single lender in the United States who's not reacting by just trying to hire a processor, underwriter, closer, funder, or a loan officer. This industry is so susceptible to the smallest fluctuation in the economic cycle that we'll end up being very, very reactive. If we wanted to get into product innovation, we just have to park, say, 5%, 10% of your resources, including your time, to look at what you want to do 12 months from now, 24 months from now. And that mindset needs to change. And obviously, some of these things, a lender cannot unilaterally do it. You need a consortium of lenders to come together. You need all of them to sit in front of the GSEs to, brainstorm some of these ideas. And I hope I answered. That's probably one of the reasons what is holding product innovation. Because process innovation always is within your control. Product isn't always. You are investing a lot of time reacting to market changes. Now let's go to your other question. You wanted to kind of get a view on the global mortgage industry. Am I right? So first comment, comparison of Europe, UK, Australia, they have an extremely simple mortgage process, limited documentation compared to US. Though amongst all of the other geographies, I would give US the best score for a credit scoring mechanism. What we have, it's a matter of pride. It's the easiest thing. If you go to some of the Asian countries, they spend a lot of time trying to evaluate the credit worthiness of a borrower. We don't need to do that. We're going to get a 3-digit FICO score, and we know what to do with that. That algorithm for decisioning changes automatically. Some of the newer concepts have been widely embraced. Let's just take blockchain for an example, right? Blockchain worked really well in UAE, in Sweden. Sweden has invested in its land registry, and Sweden is promising to save 100 million euros annually of its taxpayers' money because it's adopted, blockchain in its land registry. Similarly, with UAE, they are committing that 50% of government transactions will be in blockchain by 2021. And this is even a post-COVID scenario. So why is it that blockchain is getting so much of acceptability and we don't even have serious proof of concepts, or at least we don't know about it? I'm sure people are investing a lot. Talking about some of good examples, I have a couple of examples from here and there. South Korea, I would say one of the inspirational examples is Hana Bank. It's a one-click, fully digital from application electronically to closing electronically. And they've been doing this for the last couple of years. All they need is 36 hours. You're talking about a country that does not have a credit scoring mechanism like US, but what an efficient way of adopting technology. And for that person who asked me product innovation, I just want to go back and give an example of how a concept that TCS is also placing as an offering called living as a service. Just imagine in an ecosystem of working with a bank. You are a servicing customer. You want to know about a home improvement thing. If you want to know if someone does a home theater, someone can help you with some carpentry work. Wouldn't you have another borrower who does it? Wouldn't you have one of the entrepreneurs who's a home theater expert? Can you create an entire ecosystem for yourself? Forget creating the community within that. That's a easy possibility. We're talking about time of IoT sensors in all home equipments. Everything in our homes today are smart equipments, right? So IoT sensors are going to tell you when it requires maintenance. Can that lead to blockchain? Can that lead you to predictive repairs, maintenance, and for your bank to hold all these threads together to predict when you need a repair or to help you respond and react when you need a cost-effective home improvement solution? ABN AMRO in Netherlands is calling it beyond banking. These are things that are working very well. Very good stories of what's happening in mortgages. Let's talk about UK. There's this new company called Molo, M-O-L-O, if anyone's wanting to look them up. It's a fully digital mortgage lender. They leveraged automated decisioning and real-time validation. So this is where I call both the front office and the back office merging together, right? A real-time thing happening. There is no need to submit paper forms, and it allows users to get mortgages in a single day without needing to make appointments or interviews, which otherwise is a 4 to 6 week cycle in UK, with the rest of the banks. Very good stories. And we're talking about direct to consumer. How about the wholesale or the broker channels? Or in Europe and UK, it's called as the intermediary business. Very inspirational stories coming from Eastern Europe, company called Hypomo. I've met their leaders. Very interesting, very promising product. In Switzerland, MoneyPark. These are global online mortgage brokers that aim to simplify mortgage deals. Click of a button, it's beyond lead generation, it's intelligent, mortgage banking. I want to talk about my last example is going to be about a company called 86400 or 86,400. It actually is the number of seconds in one day. I don't think so. I need to tell you more. That's their promise. It's a fully digital bank without any paperwork. They are ensuring loans are approved in 24 hours, 6 times faster than the average of the big 4 banks that have been in the industry. Very inspirational stories. They might not be directly relevant, directly applicable, but I think there is always something we can pick and learn and apply it in this marketplace too. And that's what I had. I'm back to you, Justin or Brenna.
Yeah, I'll kick it to Justin. That was fascinating to hear just the global perspective of how everyone else is kind of doing mortgages, but I'll kick it to you, Justin.
Yeah, I don't really have anything to add. One of the great things about having someone like Karthik on this call from his spot at TCS, he sees a 360-degree view of what's going on globally here. The one thing I would just sort of add on this is that, and this is important just because I think it's going to help us frame our mindsets and planning as we kind of evolve and move forward here as an industry. Like around the world, across all industries, it really kind of just the human experience as a whole, automation is here. It's not going away. It's being embraced in every single aspect of our lives, right? And in the mortgage and home buying process side, while some of the regulations and some of the specific steps from, you know, touring a house to paying your first payment are different, at the end of the day, that human experience is still the same. And that's something where I think we need to look at not only other industries or the housing industry abroad, but just sort of everywhere we can to see where steps in the process are getting shorter, paperwork is getting digitized, and the sort of closed loop of the value chain is getting constricted. So it's fascinating for me to hear someone like Karthik kind of explain what he sees from his perch at TCS, and I thought that was a really cool answer to a question that quite honestly I was not expecting, didn't know what he was going to say. So that was really cool to hear.
Especially comparing so many different countries.
Oh, it's fascinating. Yeah.
Kicking into the next question, I thought, Scott, you did a great job earlier breaking down kind of some of the biggest things that are hindering it. And so would love to hear your expertise now, Scott, on what other tech trends do our industry leaders need to be aware of?
Sure. Well, we all know trends have to have a start, right? Like day one. So this is day one of me wearing a dress shirt in a long, long time. But don't expect that trend to continue. I'm making that prediction. More seriously, and I'm going to speed through. You're going to have to pardon my pace. I'm going to ask for forgiveness in advance because there's some great things, and I want to make sure I'm going to get into the weeds a little bit so that our audience can maybe hear some things they never thought about on some real live examples and use cases. So the first trend I see is major advances in the customer acquisition, and then on the back end on the retention side. Some real tech savvy vendors out there on things like borrower intelligence, customer retention, doing things that are at the right place, the right time, with the right message. So just in time delivery, striking while the iron's hot, whether it's acquisition or retention. This is, you have to go to their hangouts where they congregate. Justin mentioned something similar to that earlier today. So, there's all the behavioral science we talked about, geographic dynamics, custom audience targeting, even on streaming TV, ad space is incredibly affordable, more than ever before. The predictive analytics that I'm so high on, and all these triggers and alerts on life events and different things. So there's marketing and advertising templates that can go all the way down to just the agent level or all the way up to the enterprise level with real simple, easy, flexible control and compliance and administration. And that's a huge lift for organizations. Some really neat things I've seen, referrals from real estate agents are epic for a lot of loan originators. And there's some solutions out there that help you either reduce those and self-source or increase the reliance on real estate agent dependence. So unprecedented insight, efficiency, and effectiveness. And I think these things are especially useful right now, especially with the huge potential for portfolio runoff, fear of people refining away from you. Retention. I saw an interesting stat that about 70% of clients forget the name of their lender 13 months after closing. Even if that was 50%, it's still incredible. So there's some really highly creative solutions out there on how not to be forgotten after the closing, fostering ongoing engagement and all these life events and things like that, and predicting when, looking at a portfolio, predicting when somebody may do something based on, analytics and getting to them with that. All these things are very popular with millennials. mentioning predictive analytics, it's about knowing what and how much you can learn about consumers and their behaviors, and to the point of predicting what they might do next to trigger an action. Again, convergence of data science and behavior science really playing large. It's a big, big trend. Earlier, I talked about one of the travesties is failing to look at your entire enterprise and only thinking you're real tech savvy if you got a POS and you do e-closings. Enterprise level transformation, consider these 4 solutions. An artificial intelligence powered enterprise search. So what is it that you're looking for? Search your LOS, your CRM, your POS, your docs, and then literally query things like, hey, what borrowers are past due sending me documents today? Or show me my files that are yet to clear to close. That savvy, that simple, very Siri or Alexa-like. Breaking down documents and making them queryable. We've all talked about documentation and the reams of paper. Let me tell you, June of last year, I attended a tech forum in Dallas, and a top 5 retail lender who I will not name was really, really excited about their first digital loan ever, fully digital front to back. And then she kind of went off to the side of the stage and came back with a stack of papers 2 feet tall, saying, here are all the docs for that fully digital loan we just did. And it was sobering. You've got the COO talking that. So that vision alone, think about technology that can break down those docs and make each individual field a query and queryable. It's really an epic opportunity. We're really in a work from home and a global outsource environment. You've got teams spread individually and in small groups all over the globe. So I think knowledge base and single shared source, a single source of the truth via one access point, very essential. Automated workflows. You can engage partners out there that can say, hey, go into the CRM, add these 3 tasks to this account, use bots to go through checklists and do things, and then route stuff either to other applications or to humans for follow-up. It's really mind-boggling. And so what I'd ask is, everything I just went through, all 4 of those, would you be surprised to know all of those are available from a single vendor? And they have other solutions beyond that. That's the type of stuff that's out there today. Unlike never before, instant connection to exactly what you need, including all that minutia buried in reams of paper documents. Now, who's that vendor? Well, it's today's sponsor, Justin Smiling. Capacity.com. Justin and team are here in St. Louis, so I have a rare opportunity to regularly visit and see them in their innovation in action. An amazing success story, and I think that story's just being written. They really do have it all. So again, speaks to the enterprise level revolution and transformation. The last thing that I'll talk about on trends is that big data meets technology that can mine it and do something with it. So sales managers, recruiters, title agents, this one's for you. There's a vendor out there capturing every mortgage loan across 94% of the US population. They essentially replicated what Zillow did for properties at a loan level. And not only a loan level, but you can find production at a company level, at a branch level, and at an individual LO level, all the way down to the NMLS ID number. There are filters. You can subscribe to this database and you can filter what is show me everybody in a certain area that's got X amount of years of employment, industry, and mortgage. Well, how about with their current company, their tenure? What is the volume in units and in dollars? What about loan types? What about product types? What about geographic markets? Who are the title companies that they're using, and how much volume in dollars are they spending with these title companies? That exists today. I was blown away. So beyond the obvious uses for sales managers, recruiters, title agents, loan officers, there's nothing better to help loan officers understand their own worth than something like this. So unprecedented use of big data and amazing technology to mine it Loan officers can claim their own profile. They can accept messages from other users. So that's one of many, many examples across the mortgage life cycle where this big data and tech mashup ability to mine that data is really becoming transformational. I could go on, but I won't. So I just wanted to say, there are some real use cases, tech deployments. I hope that gets you thinking. Better yet, I hope it gets you planning versus reacting late in a crisis. So reach out to me anytime. I'm easily found. Thank you.
In the words of Scott, there's a lot of cool technology out there. And between you and Kartik, I think both of you are so passionate about this. Could go on for hours. Wanted to kick it to you, Kartik, to kind of expand on this.
Sure. I guess we don't have too much of time, so I'll try to keep it this brief. And I had the privilege of looking at one or two questions. I'm trying to merge my commentary with the answers. And let me just recap the questions. One was about applicability in the auto industry. And the second was a question that said whether technology is, encouraging from a consumer point of view, good behavior or bad behavior. And the second sub part of that question was, what stage of AI adoption are we at? So I'm probably going to explain widely. There are three parts to AI, ML, and deep learning, right? And everything's a subset of the other. So while I explain that, my commentary that comes on mortgage industry is pretty relevant to auto industry. So I hope I am able to respond to that. As far as generating good behavior or bad behavior from a consumer side, I think technology enables freedom of choice. You are shopping for a loan, you go into lender A's website, you do all your information, you get an interest rate or a quote. You are not, unlike what you would have done 10 years ago, gone into a branch and feel, socially awkward to just get up and leave. But today it's no longer socially awkward for you to click another new tab and then, do a similar search with another lender. I think it's just generating a good amount of freedom. It is, it's not bad behavior in my choice. It's just making everything pretty clear and transparent. Now, let me explain, how within the mortgage industry, AI, which is the largest circle I want you to visualize, and then machine learning is a smaller circle within that, and deep learning is the smallest circle within that. It's all a subset. Artificial intelligence, as all of you know, it's just to mimic human behavior. Whereas mortgage has seen success. We've seen great success in dynamic prioritization, complex rules to dynamically prioritize tasks, what you can call as workflow automation. That has been extremely successful. Interview style applications, like rather than forms, to keep your borrower engagement and improve your customer experience. That's something. Robo advisors have come in to match loan inquiry into products and etc. The options are immense. Scott touched upon the art of possible. There is a lot that can happen. And capacity, if you haven't looked up their website yet, it's probably one of the great revolutionary and disruptive leaders that are coming up in the AI/ML space. So they are doing a great job on AI adoption. Now let's go to machine learning. It's a subset of AI that is using statistical methods to enable machines to improve experience. Places where it really works is document classification. We began the hour talking about how paper intensive this industry is. Automatically classified documents, something that we do in TCS. Data extraction from the classified documents. Okay, that's a very tough thing, and machine learning is getting there very successful. Predictive modeling, prepayment modeling, default modeling. I know Scott's favorite hashtag of the day is predictive modeling, and machine learning is doing extremely well there. One more instance where machine learning is working very well is automated application completion, intelligently autofilling, suggesting missing pieces of information. Many times when you do it online, there is ML that's the brain behind this. So that's inspiring. Now let's talk about the last and the deepest subset, which is deep learning. It is a subset of machine learning, which makes computation of multi-layer neural networks feasible. Let's talk about image processing, taking driver's license in a mortgage context or even in auto context that someone asked, image detection, image localization, voice processing, moving from voice to text or text analytics, like looking through multiple documents to determine if a claim is fraudulent. It's a very, very advanced level. There is always a trade-off of what and how much do you want to invest. And that also is one of the questions, I guess, is, when do we see a break-even point? When can one invest in any of these technologies? There is a simple trade-off. You need to do a cost-benefit analysis. It always is on the availability of resources, the right skill of resources, cost, the tolerance for error that your organization can invest in, and the return on investment. One thing that I like what Scott mentioned earlier in this webinar is a pay-per-use model. No one needs to get into heavy capital investments. The market is full of extremely intelligent products, like how cloud is being used. You use only for what you pay, a tenancy model. There are multiple technologies that are available that you don't need to invest in a multi-million-dollar 3-year project to get a yield that your peer in the industry is getting in 3 months, leveraging a niche firm. I would say, as a commentary, overall mortgage maturity and success in AI is very, very high. It's very encouraging in ML, thanks to organizations like Capacity. And I would say in deep learning, we are in developmental stages. It's a long way to go. And I think the industry has started investing there. So here's what I feel, tech trends. Back to you, Justin, Brenna.
Thanks, Karthik. I'll we only have a few minutes left here, so I want to close, I guess, by saying this. Like, the big thing to keep in mind here is that good software, good technology is really an accelerant to good people, good processes, and a well-run organization, right? So in our world, you see, I think, a couple things that are really cool. So one, I'm seeing, to Scott's point, that we're starting to see, rather than maybe piecemeal vendors, right? You can start seeing some more entire or bigger chunks of the operational tech stack being used. And and just as a marketer at a SaaS company, it's interesting because we spend most of our time really only in 3 places: Salesforce, Marketo, and WordPress, which is where we do our website. But there are other vendors, or there are other industries and other disciplines where you might have to touch 6, 7, 8, 9 tools, right? So I think it's exciting to see, in one hand, you have sources of truth and sources of engagement being sort of merged into single tools. But then on the other hand, you have these platforms, especially as we've all kind of gone to the cloud. The API availability on these platforms has led to some really interesting things, which is a lot of what the power of some of the workflow automation and stuff that we're building is unlocked from exactly this. Is let's take information from one application, process it, send it to another, get the results from that, process it, give it back to the user who requested, right? And that automation, that trend of going towards automation, is something that I think is unstoppable. And quite frankly, I think it's extremely exciting. One of the questions that was asked here is compare and contrast outsourcing versus automation and the CapEx associated with automation. So I'll say this, when you think about automation, right, and you think about outsourcing, here's the way I look at it. Automation can prevent outsourcing in the first place, right? So give you a great example. We have a customer who has a bank or credit union technically, who's grown their asset size by about 40% since they've implemented us, but they have not added one call center agent to their team during all that growth. And furthermore, the spillover from their full call center, if their internal call center is full, they spill over to an outsourcer. That's going down as well. So you have to look at it as the first order effect of getting through a widgetized process faster, but also the second order effects of what you're preventing from good automation even taking place in the first place. So I don't always agree with the assumption that implementing automation can be high capital expenditure. It can be, but I think there's also ways to look at bringing automation into your organization at a scale that the benefits can be realized pretty quickly. I'll give you a great way to think about this. So you have, if you could save 60 people 10 minutes each, that is not quite as impactful as saving 20 people 30 minutes each, right? From a human time perspective. Now, when you get into like the transactional sort of per unit economics of large scale automation, this would be in our, we're working with some clients now on kind of doing some document processing, and when the graceful handoff has to occur, we send it to someone to look over, otherwise the documents are processed. Another great way to look at this is like Tesla manufacturing cars. If they can shave a few tenths of a second off of a particular point in the process, and they can do that hundreds of times, it all adds up. But that type of savings is realized a little differently than giving 20 loan officers 30 minutes back versus 60 loan officers 10 minutes back. So I say all this to say that outsourcing and automation both have an upfront cost you have to pay. There is the downstream and second order impacts of implementing either one of those sort of optimally. But for me, what I think is sort of most exciting is that when you outsource and you scale, you still have to scale the outsource, the amount of people and the amount of things you're outsourcing, especially in like a call center type environment. In automation, the incremental cost is much less because you're just dealing with tighter tuned processes, if that makes any sense. So, in general, I think the industry is moving towards a very digital first, very receptive place when it comes to these new technologies. And I'm very excited to be able to do what I can to spread the gospel of capacity in this, and also to be invited and participate in conversations like this with thought leaders like Scott and Karthik. And I really can't thank them enough for joining me today and sharing some of their wisdom. This has been awesome.
Yeah, just wanted to say, as we close out the webinar with a few closing thoughts, real quickly, wanted to remind everyone that we will be sending out a copy of this webinar to all registrants within 24 hours. So feel free to check your email there, or you can go to housingwire.com and check our Knowledge Center, where the webinar will be posted as well. Also, if you submitted a question and we didn't have time to get to, I know these three have so much knowledge to share, so they'll be reaching out to you directly if they weren't able to get to those. And lastly, I just want to say thanks to you three, Justin, Scott, Karthik, for sharing kind of the insights on where innovation is, not only in the US, but globally. So thanks again for all three of your time.
Thank you.